I'm joined by Dave Stockert, President and CEO of Post Properties. Dave, Post focuses on the upper upscale apartment sector. How has your area been affected by the economic downturn?
Sure. We've, not unlike everybody else in this economy, we've felt the pain of the economic downturn. We tend to operate in locations where our product would appeal to someone looking for a higher quality or a better in-town location. So in that respect, we're able to, as we adjust our rents down in the face of the economic reality, we can draw some demand from other apartment communities or other forms of housing that might be less desirable. On the other hand, though, as the house prices come down in other parts of our communities and other parts of our cities, then people are able to go out and take advantage of some of those house prices. So we pick up some folks on the one hand and we lose some folks on the other hand.
And have you adjusted Post strategy at all because of that?
Well, clearly, I wouldn't say in terms of a pricing strategy that we've adjusted it so much. We do try and run our properties optimally at about 95% occupied. So we try to find the market price at which we can keep our properties full. That tends to be the best way for us to operate through a cycle. Now, stepping back corporately, we've done a number of things, balance sheet-wise and other things on the cost side, the corporate overhead side, to address what we're facing in this economy.
What about on the development side? Is that one of the areas that you've had to change?
Well, clearly, clearly we've scaled back the development activity. We're wrapping up some projects that we'd started earlier. Those are now in lease-up. I think it will be some time before new developments will make sense in this environment. And in the meantime, that'll be productive for our existing portfolio. We should start to, at some point, see some turn in the rent dynamics.
And you mentioned the balance sheet was another area that you had to address. What were some of the steps that you've taken, and do you now feel comfortable where your balance sheet is?
Fortunately, we're blessed to be in multifamily, where the agencies really have been steady throughout. We got very aggressive early in the year to take down some agency debt, which was very attractive. The other thing we did is we put some assets on the market to try and generate liquidity, and we were able to complete those transactions again because of that availability of debt. And so today, our balance sheet's in very good shape. We don't really have any maturities to speak of in the near term, and in fact, we have cash, and probably our biggest challenge is the fact that we're earning nothing on our cash, essentially.
Is there an ideal leverage amount for your company that you'd like to be at?
We have historically run at roughly 50% of asset value, and we were heading into this downturn. We were at or below those numbers. Now, asset values came down, and so our leverage ticked up a little bit, but we were able just in the last couple months to raise a little equity. And so right now our leverage is right where we want it to be.
Dave, thank you very much.
Thank you very much.
For REIT.com, I'm Matt Bishar.